Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from X. Today, I'm joined by John Polomny, a fellow contrarian, investor, YouTuber, and a founder of Actionable Intelligence Alert. John, welcome to my show, and thank you for coming.
Happy to be here. Thank you.
Thank you very much. I will skip the part of the introduction this time since you're pretty known name among investors. But for the record, I really like your views on certain things, and I see a big similarities with my investment philosophy. Let's start. I know that you are following central banks all over the world, and that you are pretty familiar with macro trends. My first question to you is related to the money in the system, liquidity. What is going to happen next since we are actually looking at another round of liquidity boom?
So, yeah, I do track central bank activity because I think that, what I learned from Stan Druckenmiller is that in the short term, sentiment and liquidity is what basically drives markets. Obviously, performance of a company or an industry in the medium to long term will ultimately determine how it performs. But in the short term, liquidity is very important. And what we're seeing now is what I saw basically about last August or September. Let's dial it back. So, we had the pandemic, we shut the world economy down, we had a lot of inflation, and most central banks around the world, then when they saw the inflation, they started raising rates as a way to counteract that inflation. A lot of the emerging market central banks were the first to do that. Most of the developed worlds, the ECB, Fed, BOE, Bank of Canada, they were late to the game. And so what we saw is a shift. Inflation did come down. You cut back the amount of money in the system. It's going to contract activity. And inflation came down pretty decently in some areas. Not so much. I know we can talk about the U.S. in particular, but in a lot of the emerging markets, the inflation came down rapidly. And then the central banks, what I saw was around August of last year, a shift towards a new rate cutting cycle. And it started in the emerging markets. Obviously, those aren't the big drivers of global liquidity. What I call, you probably got 4 or 5 of what I call the bazookas, Bank of China, Bank of Japan, US, ECB. And so China has had some, coming out of the pandemic, a lot of economic problems. But what I was focusing on was this overall trend. And I saw that global liquidity was slowly but surely increasing. I use some other metrics. I mean, Michael Howell is a guy that talks a lot about liquidity. He has a proprietary methodology. I don't really have, I just try to get the overall trend right. And so what I am seeing now is just in the last couple weeks, we've seen the ECB begin a rate cutting cycle. The Bank of Canada, I mean, basically the last 2 bazookas that haven't fired yet are the Bank of England and the United States, but that's coming. We're seeing the economic deterioration will be sufficient. The problem here for the central banks are, look, I don't think like this is like the best thing. I don't want to go off on too much of a tangent of philosophical economic theory, but, running around using this 10-pound sledgehammer to try to kill flies in your house, that's what this is akin to, is not good. This is basically central planning. I'm just saying this is the way things are. And we know that when we get into a liquidity upcycle, when people are cutting rates, we see certain intermarket relationships, certain things happen. Long bonds will go up in value as rates come down, for example. Typically, there's a lag, but you will see gold do well in that situation. You'll see emerging markets do well because as you cut rates in the U.S., the dollar will decline. Dollar's holding up very well now relative to a lot of other markets because if the other central banks are cutting rates and the Fed isn't, then there's this discrepancy in rates, and more money's, this is all intermarket relationships, and so they're all have to be taken into consideration. But long story short, we're going to be into a global liquidity cycle, new one, that I think is going to be very inflationary. Part of the problem here in the US is with our central bank here, which is the big bazooka. You can go back and look at previous rate cutting cycles. It will not be incremental. When they finally decide, they'll be late, they should be cutting rates already, but they're not, because they have a fear now because of their flip-flopping back and forth over the last several years. They don't want to be seen as getting it wrong again. They got it wrong when they said inflation was transitory. And now they want to, they're stuck on this, we have to get it back to 2%. I don't know where this number came from, but that's what and I don't think they're going to be able to do that for many reasons, which we can get into. There's secular reasons that aren't going to allow that to happen, but they're going to be forced into it. You could see the deterioration now in employment beginning and some other indicators. I was calling for a recession last year, but I was wrong. I freely admit it. I didn't really fully account for the amount of fiscal intervention by the government and giving out free money. But I think we've got to the point where we've exhausted that, and now higher rates are starting to bite. And so they're going to be in this situation where I don't think they're going to be able to get the inflation rate down to 2%. And so you're going to start seeing a change in public discussions from the Fed and other central banks about, well, we don't really need to get to 2. That's kind of an arbitrary number. And then because I think, what's going to happen is the economic situation is going to call for this. The Fed can't stay here too long if other central banks, especially in the emerging markets, keep cutting. That could also create that could create some distortions in some of these emerging markets. If they have, for example, if the dollar stays high and moves higher, and you have to pay your debts in dollars and your currency is depreciating, well, that causes stress to emerging markets. We've seen that in the past, in 1997. I'm not suggesting that's going to happen. I think that by the end of the year, you're going to have all central banks cutting rates. And when the Fed does this, they don't do it incrementally. They will start at first, but typically, as they're behind the curve, the economic data will be coming in. They'll be moving very quickly. You can look at previous rate cutting cycles, and the typical rate cutting cycle is 500 basis points. So we could very easily be, this time next year down at 1% on the Fed funds or even lower, reinstituting QE. And then from that, I think then you have to discuss what does that mean for various asset classes. And so I think that's kind of the best way that I'm kind of looking at this overall right now.
Good point. You mentioned sentiment at the beginning. What is your opinion on the current investment sentiment overall, and actually, how do you measure it?
So I have different tools. They're more anecdotal than necessarily, you can look at breadth indicators on the market, advanced declines, new highs versus new lows, things like that. We talked a little bit briefly before we came online. I have my own kind of anecdotal things just based around my newsletter business, some of the things I see on social media, on how I kind of try to just keep my finger on the pulse. It's kind of more of a broad way of looking at it, but I have been through various market cycles. I'm 57. I've been doing this for a long time. I went through the tech bust. I mean, I was around in 1982. I was a young teenager, and saw what happened when Volcker cut rates, when the Reagan administration deregulated the U.S. economy, the boom that happened from that, the 40-year bull market in bonds. I saw the tech bubble. Okay. I saw the bubble in housing. You can actually go on and find like prehistoric podcasts that I made in like 2006 and 7 talking about the housing bust. I was able to dredge some of those up. But anyways, I've seen these bubbles before. We're in a bubble now, this AI, generative AI data center thing, where you have a company like NVIDIA that has a $3 trillion market cap. That's bigger than the stock market in the UK and I think even Japan. So one stock. And then, I hear the same kind of pushback. I'll throw these things out there as like chum in the water to see how people react. And they react the same way that people reacted, the same excuses, the same justifications for this over 41 times sales. It doesn't matter that it's a good business and what AI generation is going to morph into. We saw the same thing during the internet bubble in the late 90s, like 2000. Yes, Cisco and Microsoft and all these companies were profitable. They did, but the valuations were so high that once the bubble cracked, once the sentiment changed, the valuations compressed rapidly. The thing to note during that, though, is has negative sentiment right now. Things that I'm interested in: value stocks, emerging markets, resource-based stocks. Okay, some of these things are trading at record low valuations relative to the equity markets, the S&P 500. So that's where I want to focus my efforts that I've seen in the past. I mean, I'm a student of like playing poker, and I used to play online, not necessarily to make a lot of money. I just enjoyed the mathematics and the risk and the pattern recognition. But it also, you could see psychology involved too. And it's the same thing in investing. If we see something happening over and over, and we're going to see things, nothing's going to be exactly the same, but history does repeat because we're dealing with human beings, and their psychological motivations don't change. Fear of missing out, greed, these type of things. And so you see the same patterns developing through different market cycles and bubbles. And I think that the thing to be careful about, what I want to warn people on, and a lot of people are saying, yeah, we want the Fed to cut rates, that'll be great. The Fed will not be, like, again, they will be late. And so it's, go back and look at like the stock market, what happens during the initial phases of rate cuts, the market will go down. So I caution people. I'm starting to get a little bit nervous now because I think a lot of people don't understand. They say, well, if we have this global liquidity cycle, gold's going to go up, gold stocks will go up. The initial, like I said, the underlying fundamentals that cause these central banks to want to cut rates, or in fact cut rates, these things all operate in lag effects. So the day you cut rates doesn't mean that the economic cycle changes. These things have long lead times and lag effects. And so what I will say is, by the time you start cutting rates and this overall stock market drops, you could see a drawdown in the past during something like this, 40 or 50% or more in some of these indexes like the S&P. And so what I will caution people is, be careful here, because you're in a phase change, if you will, in the markets. And uranium stocks are stocks. Gold stocks are stocks. Copper stocks are stocks. Oil stocks are stocks. If the overall market is going down because sentiment is negative, those stocks will go down in sympathy. They will be the first to recover, and they will have that tailwind. But be understanding that in that 6 month to year period, as you go through that phase change in sentiment, if the stock market drops, these things are stocks and they'll drop. Doesn't necessarily mean that the underlying fundamentals are different. It's just when you get into that sentiment, and especially in these resource stocks, there's small caps, liquidity dries up. You'll see gaps down and things like that, but nothing will be different at the mine. You know what I mean? And so this is an opportunity, but I really am starting to begin to caution people, because I think people have it in their head, well, the central banks will cut rates, that's liquidity, we're off to the races. That will happen over a period of time, but the initial shock because of the overall sentiment. I mean, if NVIDIA gets cut in half, and the Mag 7 and the S&P's down 40% and the NASDAQ's down 60 or 70%, all stocks will be, 95% of stocks will be down for some period.
Yeah, agreed. And especially on the part that some companies are very overvalued. You mentioned NVIDIA. I know them a few. I know them a lot more, that they're worth, like, all sectors. Let's say Budweiser or Heineken has a much bigger market cap than the whole uranium sector, and that is really shocking to me. Okay, let's discuss uranium. This is your biggest investment, if I'm not mistaken. How do you see that trade playing out in the years to come? Of course, in the circumstances where we will not have any big major crash.
So I've been, I've actually worked in the nuclear industry. I have been an advocate for nuclear power for years. And I think, obviously, becoming a bull on uranium 5 or 6 years ago, whatever it was, I don't even remember now, when virtually no one was talking about it, I never anticipated the change in the zeitgeist or among policymakers, among the population. We are now in just even in the last 18 months to 2 years, have shifted from indifference, if you will, or even a negative view of nuclear to now everybody's pro-nuclear.
Yeah.
And so this is happening in the context of a supply-demand situation in uranium, which, depending on how you want to listen to, is going to be multi-year, possibly decade plus to resolve. So I am look, I'm a generalist investor. I'm not an expert on uranium. I'm not an expert on anything. So I look for things that are cheap, themes that have a long period to play out, something that's at an inflection point, a phase change. We've seen that several years ago with uranium. And so I think that with the amount of money now that's being thrown at it in the billions of dollars to build new plants. I mean, when you have the Energy Secretary of the United States say 2 down, 198 to go, what she was saying is when she was at Vogtle 3 and 4, which is the last recent plants that were built here in the United States, 1,000-megawatt units, she's basically saying that that's our policy going forward, that we have to build 198 more of these in the next 20 years or what have you. So that, to me, is positive on the demand side. It's now a growth industry, especially in the global East and South, which I'm very, very stoked about. That new Fertile Crescent from, Istanbul to Vladivostok, and those 4 billion people that are in that, grouping. The energy requirements that they have and things like that. I think what we see is a lot of folks, especially in like the developed markets, have what I call home country bias. They just kind of focus on, if you're in the US, you kind of focus on the US. If you're in Europe, you kind of have a tendency to focus in Europe. There's this these places are becoming less and less relevant, which I don't want to drift off into geopolitics, but just economically, as the rest of the world, these emerging markets now continue to, I mean, you just saw the other day, I think it was the IMF or the World Bank came out with like the top 10 economies in the world, and 4 out of the 5 are in this global or in this new Fertile Crescent. So the requirements for energy are insatiable because people's desires and wants are insatiable and require more and more energy inputs, and you're just not going to get there. I mean, I build renewable plants. You're not going to get, I'm agnostic towards them at this point, but they're intermittent. You can't run a generative AI or a data center, which requires all this power based on, if a cloud bank comes over or if the wind stops blowing. You need 365, 24/7, 99.9% reliable. And that's what you're going to get from nuclear or natural gas fired power plants or what have you. So I'm very bullish. The fundamentals are awesome. Now you have basically all your major governments around the world behind this. And so I just think it's going to be a multi-decade. When we talk about the energy transition, it's going to be nuclear. And we don't even need modular reactors, just based on what's happening in China and India and even in the US. I mean, they're talking about turning 3 Mile Island back on. That's where you had the nuclear accident in the US in the late 1970s. They're talking about bringing that unit back on. That's how, I mean, it's just a total phase shift, and I'm very positive about it. Now, the problem is there's been insufficient amount of investment made in uranium. Yes, we've seen a lot of most of the brownfield stuff's been turned back on. Okay, Langer Heinrich's back online. Okay, Boss turned theirs on. Encore's turning on their South Texas S's, but these are so
small.
They're not going to solve the problem. I haven't seen any. I keep seeing more and more reactors being announced or started, or I told people, go to the World Nuclear Association. They have a tab, new nuclear. So you go on there, you see, okay, well, they just started the foundation, or they just put the, steam generator in or whatever. This reactor just went critical. So you have this constant increase in demand, but where's the billion-dollar investments and commitments to bringing on these huge mines that need, when's NextGen going to bring their Arrow mine on? No one knows. Okay. Cameco struggle. We know Kazatomprom struggles. And so I think if you look at it just at a 30,000 foot level like that, I mean, you can see the opportunity. The problem is, for a lot of retail investors, they don't have a lot of patience.
Yeah.
And so I brought this up. Ocean Wall, who's does real great work on this. They had a report out last week. I think I put it up on one of my videos. But they pointed out there's been 8 double-digit drawdowns in, they used URNM as a proxy for the uranium industry, the ETF. There's been 8 double-digit drawdowns in that ETF, some of which were like 40 and 37% in the last 4 years. And so it's an extremely volatile industry. The stocks are extremely volatile. But I kind of pointed out before, you should use this volatility as your friend, as you're in a long-term if you look back at the end of this, whenever it is 10, 15, 20 years down the road, whenever this secular bull market, I mean, supply and demand works. They'll throw enough capital at it, and there's no shortage of uranium in the ground. It's just political will for permitting and then capital. So it will solve itself. But in the meantime, you have these gaps, depending on who you want to look at anywhere from 30 to 50 million pounds per year. And this is becoming cumulative as you're adding more reactors. And so you're getting into this, what I have forecast is going to happen, where I think you could get a spike, is you're going to get an announcement one day where somebody wasn't paying attention at one of these utilities. And then it's going to be like musical chairs when you were a kid. You put 5 chairs and there's 7 kids, and then they stop the record, and then you're out. So I think then it's going to wake people up. In the meantime, the problem that people have, and I get a lot of email about this and comments, you suck. All you guys go on about uranium, don't know what you're talking about. Guys, look at the volatility in this industry. If something drops 40% and nothing's changed fundamentally, you should be in there buying. What happens is, as you well know, with retail investors, is that they chase the shiny object. They're like a walleye. You have a lure, and then they chase it, and they're primal. I want to get in because it's fear of missing out. So I'm going to blow my wad at $106 a pound uranium, which happened a few months ago, and then it subsequently drops because everything's overbought and everybody is in. And then it drops 30 or 40%, but nothing's changed fundamentally. And then, then they feel rug pulled. Well, that's because, do you have a thesis? Do you understand what you're buying? Everybody has it in their head that out of the 300 publicly traded uranium juniors that are running around out there, that most of them don't have a good property or good management, that they're going to find the one that's going to go up 5,000%. So I can put $1,000 in and be that guy that's, becomes a millionaire. That's not how this is done. So I think that's my view on uranium. I kind of was a little bit long-winded there.
No, it's a great answer, and I tend to agree with everything you said. You mentioned uranium explorers. My question is, how are you positioned with uranium equities? What group? I will not ask you any names, of course, but what group of equities do you prefer with uranium? Is it the producers, developers, explorers, or maybe the ETFs?
I'm mostly now just in the ETFs. I just use URNM. I sold off a lot of my juniors. I had massive gains. And so, there's nothing wrong with like the management at Bannerman or Deep Yellow or these other companies. But when are they going to build a mine? How much money do they need? Where are they going to get the money? And so we're in a situation now where the price of uranium is going to go up, and I want to focus on producers. I mean, I'll mention a name that's not in my newsletter, but I own the stock, Encore. I think Bob Sheriff is one of the best CEOs in this industry. I mean, they bided their time. They brought these units. They're bringing on the second unit online, and he's going to be positioned. He's going to have they're going to have cash flow, and there's going to be other opportunities. Made the deal with Boss Energy, and so there's going to be opportunities where people are capital constrained, and if you have operating units that are kicking off cash flow, well, that's going to open up more opportunities for joint ventures. I mean, there's a lot of uranium just here in the U.S., and there's a lot of rinky-dink mine. There's a lot of consolidation potential. So I look at companies like that. If you're just going to be out there, look, if you're a generalist investor, unless you're going to devote a lot of time to this, like a guy like Justin Hune, his whole life revolves around uranium. I mean, for the average person, you're just better off getting the general trend and realizing this is a multi-year trend. Wait for a pullback where sentiment's terrible and everybody hates uranium. And then just, depending on how much risk you want to take, buy URNG, those are your juniors, or buy URNM, something like that. or just buy the physical uranium via the trust. So that's what I'm doing at this point. There's no reason. I don't need to go. I already made a lot of money in the junior because we bought them at like pennies, so there's still a lot of meat on the bone, but this is a more nuanced situation, I think.
Would you care to share us the names of the juniors?
Not really. I mean, I'll throw one out there that I think is a speculative thing that I think is really, because it fits into my geopolitical. I mean, Global Atomic is going to build that mine this cycle, and somebody's going to build it. You saw Urano now got kicked out of Niger.
Yeah.
I saw some people speculating that, Kazatomprom could end up somebody's going to build that mine. It's going to get financed. We saw some news this week talking about U.S. banks being involved in the consortium of lenders. So I think that people have shall we say, it's speculative, obviously, because you have a lot of unknowns, but I think that has a potential to really do well. That DASA mine is going to get built. So that's one I would say. Yeah.
Yeah, that is one of the best projects in the world when it comes to economics, definitely. Okay, let's turn to gold. Do you believe that gold is just warming up? Are we in for a much bigger move anytime soon?
So, I was listening to Ronnie Stoffel from Incrementum, and he pointed out something that stuck in my mind. Look at the deficit. I mean, let's look at, for example, the United States government. The Congressional Budget Office in their recent report projected that the total debt is going to grow from 35 trillion in the US to 50 trillion by 2033. It'll be over 50 trillion by the end of the decade. They're always off. They're making a lot of dumb assumptions that long-term rates will be 2.1%. We won't have any recessions.
Yeah.
And so we know from history that we don't have the ability to pay for this stuff. I don't see anybody in the political class, whether it's Mr. Biden or Mr. Trump, that's going to cut spending. They're both MMT type guys. There's nobody in the Congress. It's just not going to happen. And so we know from previous times in history, the only way to get out of this is to debase the currency. But you can't increase, for example, gold or Bitcoin or anything that's a hard asset to that same extreme. So you're going to see they actually calculated how much. It's not just the United States. The ECB's in the same problem. I mean, these countries they've all of them have pretty much exceeded their. I'm talking about the major economies. Exceeded their debt to GDP ratios, and they just sweep it under the rug. And so a lot of currency units are going to be created over the next decade around the world. And you just can't do that with gold, for example. Men have to go into the ground with machines. It's very difficult. It's hard to extract gold. And so you see gold increase maybe 0.5% to 1% a year, the total gold stock. And you're going to see the currency units are going to expand quite rapidly. So that's my long-term thesis. I go back to what Ray Dalio said. Everybody should own physical gold and gold, not as an investment, as a speculative investment, but as savings, because it's a currency like the dollar or the euro. Because if you don't own gold, and he got laughed at when he said this, he was sitting up on a stage and people laugh when he says, if you don't own, and I agree with this 100%, I think this is the best reason to do it. If you don't own some gold, as you don't understand history and mathematics, it's just that simple. And so I think that from that perspective, physical precious metals are a good investment, savings, if you will, to protect against central bank and government malfeasance. But I do think there's opportunity in gold stocks. I think gold's going to go a lot higher. You can look at, people have done different calculations. If you look at the money stock of currency that these governments have relative to the gold stock, you can make a logical, and this seems provocative, you can make a logical view that gold could be $10,000, $20,000 an ounce. At some point, the monetary system is going to have to be reset. And I think what I'm starting to see, especially watching what the BRICS are doing in this emerging, they don't really trust each other that well. And they're, if you're somebody that wants to get out of the Western banking system, or you have a family office, are you going to go meet with a financial advisor in St. Petersburg and put your money into Russia if you're an Indian billionaire? Probably not.
Yeah.
But so I think what they're going to end up doing is using some type of commodity-based or gold-based mechanism for their trade, because their trade is rapidly expanding amongst themselves. I think that gold is slowly but surely being remonetized. I think that's the tailwind. Central banks are who's been buying gold the last 2 years. Eventually, if it gets moving, the shiny object retail will come in. But I think it's overbought in the near term, and you just got to sit there and wait, let the 200-day and the 50-day moving averages catch up, and then, again, Money Fest 2024 with all this central bank rate cutting, which is actually money printing in disguise. That's kind of your tailwind. So yes, I'm very positive on gold and certain gold mining stocks. I think there's tremendous value there.
Okay.
So
Would
not in general, but you have to be selective.
Sure, sure. Would you say the same for silver, or you have a different approach here?
I think all the precious metals. Silver obviously is a kind of everybody knows, is kind of a quasi situation where you have an industrial usage
Yeah.
and a investment usage. As gold prices go up, it's what we saw in the last monetary inflation in the late 70s and early 80s. It's the poor man's gold. So you'll see people buying silver when they see this trend move. But I think it's the same thing in the gold and in all commodity markets, under investment. You're seeing depleting mines, and with if you want to talk about solar and all that stuff, what goes in silver going into all that. I'm extremely bullish on the platinum group metals. I think the EV ESG thing has kind of peaked. I don't think the linear extrapolation that people had on the growth of EVs over time, yes, they're going to be present, but I think your platinum group metals and petroleum is going to be around a long time. And I think platinum, I think, is trading under $1,000 an ounce, and it's 17 more times scarce than and where does all your platinum group metals come from predominantly? Well, South Africa, which is a basket case, and Russia as a byproduct of Norlys Nickel's mine in the north. So I think you're going to see, because of the geopolitical situation, it kind of ties into all this around uranium and some of these other metals. You're going to see, talk about shooting yourself in the foot, stomping around. You have the United States has a nuclear navy. Their nuclear triad of submarines and surface ships are nuclear powered, a large part of them, the large capital ships. And then you have 20%, almost 20% of the United States' baseload power is nuclear, and yet we produce virtually no uranium here or process any or enrich anything here. Now that's going to change because they're throwing money at it. And then you go around and say, okay, well, we're going to ban Russian imports. Okay, but you'll notice if you read the legislation that there's waivers can be granted. So it's interesting to see. So you start getting into these geopolitical things. Now we're ramping up sanctions against China. You're going to get into a tit for tat. This is going to be bullish for metals. War is bullish for metals. I wish these things weren't happening, but I have to look at these things for the way they are, not the way I want them to be.
Yeah, that's the right approach, of course. One other commodity that has similar superb future, I would say, is copper, maybe for a longer run than uranium. But are you bullish on copper? Do you hold copper stocks? What's your take?
Yeah, I'm long-term bullish on copper. You can see the diminishing head grades at mines. Again, you're into this you look at what's happening at Codelco in Chile. Their production is not even holding steady. It's going down. And they've put some stupid policies in place there to disincentivize. They told Anglo American wanted to make some additional investments there, and then they had some stupid rider in the agreement where Anglo American had to replace wood burning stoves in Santiago. This is dumb. This kind of nonsense. The companies just throw their hands up. You saw what happened in Panama at the copper mine there. This is further risk it's interesting to watch the political class and the commentariat talk about an energy transition, and then the one metal that you need to accomplish that, people are doing everything they can to hinder its. Again, there's no shortage of copper. It's just the easy stuff's been found. You'll need more investment, more time, and you're going to have to go to areas that are not where the rule of law is not the best, like Democratic Republic of Congo, places like that. So, yeah, I think it's bullish long term. I've heard some people talk about, well, we can just substitute aluminum. Well, in certain cases you can, but there's a reason why you use copper instead of aluminum. You're not going to, I don't think you're going to make transformer windings of, these large voltage transformers out of aluminum. So there's the use case there. And again, you don't need any of these additional like EVs and ESG, just the sufficient demand of that 4 billion people that are in that emerging global south and east is enough to drive this copper demand.
Mm-hmm. I have few questions from my followers for you, like 4 questions. So if you could answer that would be great. The first question would be, what's your take on the real estate market?
Well, I mean, it depends what you're talking about. In the US, it's overvalued right now, like all assets. I think that people are priced out. We kind of had a unique situation. You're starting to see during the last interest rate cycle, so many people refinance. I mean, my mortgage is under 3%. So when you had an inflation rate of 5-6%, I'm basically I'm getting paid to have a mortgage. So a lot of people are locked into these mortgages, and so you haven't had the price decreases. So am I a big fan of real estate? I think if you have a long-term mindset, I tell these young guys that work with me on thing, I say, if you want to become wealthy, look at the easiest way for somebody to become wealthy long-term in the United States is just, I said, buy a rent house every year for the next 15 years, 20 years, and you'll be a multimillionaire when you're in your late 40s. Do they do it? No. But this is another cyclical thing. It's location dependent. Overall, I'm not interested in buying real estate in the US because I see the United States, I don't want to own real estate here. Maybe
Okay.
select locations like some of these red states, but I mean, I have a view that the United States won't exist as an intact political entity in the next generation. So why do I want to own real estate here? There's emerging market real estate. There's potential there, yes.
Okay, next question. If you have $1 million to spend, what commodities or what stocks or what categories would you buy?
If somebody gave me $1 million today,
Yeah.
I would put it all in U.S. Treasury at various 5-year, 10-year, and 20-year as a trade through the end of the year into the beginning of next year. You'll probably have a 30% capital gain. You're going to be in safety, and then you'll be, I think, after you have a big pullback in a lot of these things, you'll be able to recycle that into the next upswing into resource markets. I think we're going to have the market come down. I'm not saying crash. We're going to have a pullback. I don't know how big it will be, but as rates come down around the world, and depending on where you are in the world, I mean, you should be buying treasury or government securities. Now, you don't hold them duration because they're a mug's game. Inflation is going to eat you up, but there is a trade there. And I think you just need to hold your powder dry for right now. And I think that you're going to have tremendous opportunities in a lot of these sectors. Of course, no one knows the future, but that's how I would answer that question if somebody
Okay.
came to me. That's what I would say.
Okay. Next question, due diligence. What metrics are the most important to you when buying some stock, some equity?
Well, the overall thing for anything and any business is the management. So I think a lot of people ignore that. You can have a great project or a great business and it can be wrecked by poor management. Case in point, look at Boeing. I mean, it was a tremendous icon around the world, known for safety and engineering prowess. And because it was financialized, because a lot of people in the West have financialized, I can cut back and lay off all my old machinists and stuff like that, or force them into retirement, pay lower wages. Because what I think is what you see is a lot of people manage these businesses for the short term. What's their incentive? Are they being incentivized by stock-based compensation? And then are they a mercenary? They come to a company, cut for 3 years, get the earnings up, the stock goes up, go into debt and buy back shares, and then cash out and move on like a virus to the next company. So I think especially in the resource markets, you have to know the management. Have they done this before? There's a lot of, I'm amazed that, pick up the phone and call these people.
Yeah.
Have they done this before? Do they know what they're doing? success breeds success. Success leaves clues, right? And if it's just some bunch of young guys that got together and said, well, we're financial guys from Toronto or whatever, and we're going to do the, okay, what's really going on there? So I think I would look at that, and then look at like how some of these companies treat their shareholders. I'm not going to mention the managements. We all know who the companies are that are have lifestyle managers and CEOs.
Yeah.
And I would stay away from that. You really have to understand what you're getting into.
Good point. Two more. In your opinion, what places or jurisdictions are the best for investment in the world, and which ones are on your no list?
Well, nothing's on my no list because you're talking about the timing. I own European banks right now. The managements, with one or two exceptions, are horrible. They stink. Okay. They made bad decisions, but they haven't made any loans in the last 12 years. So capital has now accumulated at Commerce Bank and at Unicredit. Well, Unicredit's being run properly now, Barclays. And so what are they doing? They're overcapitalized. So they're buying back shares. Their net interest income has been high because rates are high. And so they're just sitting there. They've just been able to, so that's more of a trade, right? I'm not like enthralled with these companies, but so it depends on your timing and your time duration. Countries, the West is in decline, in my opinion. The value systems, the things that made it successful, we've gotten away from that. We are in demographic decline. I don't know why. I don't want to get too far into conspiracy theories. I don't know why we're importing this peasant class from the third world into the. I don't see what the advantage is. No one's explained it. No one understands what's happening. I do see a lot of conflict happening in Europe and in the U.S., and I just don't know how that ends up. Is that actionable next week? No, but that's a trend that's in place, and I don't know how incompatible cultures get along. You have an example. Islam is what it is. You had elections recently and mayorships in the UK, and you have people that are from this particular religion that are proudly now saying, because they have the sufficient numbers, that they want Sharia law. Is Sharia law compatible with the rights of men in the Magna Carta in the UK? And that, is Sharia, if it takes over in the subjugation of minority populations and women, and is that going to be conducive to investment in the UK if you trend this out? And so this is not going to be investable at some point. You're going to have to look at some of these things because conflict is going to arise there. So I'm more looking at this emerging class of people in the global South and East. You got to pick your spots, and you're going to entail more risk. But I think the opportunities there are. I'm talking about longer term now. If people want to give me exact countries, okay. What I would tell somebody that's in their early 20s that's kind of discouraged, go to Africa, go to Central Asia. You have the ability to do things that people, you're not going to be one of a million. You're going to be one in a million. You show up, you know what you're talking about, you have a plan, you can bring skills there. There was a guy, I read about this, when the Eastern Bloc countries were leaving communism, he went to the Czech Republic. He somehow ingratiated himself with people that were coming into power, and he would set deals up, and he would give advice to different ministers, and he would always take a little piece of every deal. Okay, he had his fingers in a lot of deals. And as this transition from socialism, communism to free markets happened, well, that's a tremendous, inflection point, right? And we know what's happened in a lot of these countries since then. And so there's always going to be opportunity. I would say, with how easy it is to travel around the world, well, currently, unless the Europeans shut all their air travel down, but it's easy to travel around the world. And with the ubiquity of the internet, we're talking over this. You should make the whole world your opportunity set, not just focus on your one little country or what have you. And I think people are able to do that. So that's what I would do. I think people should travel and look at things because you get skewed. Look, I've traveled all over the world. I've met a lot of people. I've worked in a bunch of countries. What you hear in the media in the West is not accurate most of the time of what's actually happening down at the deck plate level. I mean, I've been to just about any country you can go to in Africa or some of these emerging countries. You're always going to run into some Lebanese businessman that's there, that's grinding something out, getting something going. I mean, if you have that kind of ability, and then even now, just like investing, it's like the world, it's so easy now to allocate capital to some of these situations. So I would say get yourself thinking about the world as a whole and not just, and then again, you have to fight your biases because we're all biased to a certain extent.
Of course.
And, I think that comes into play too. So anyway, yeah.
Yeah. Final question. Who are your top 5 people from X that you respect the most?
Top 5 people, what was the question
From
again?
X, from Twitter, that
Oh,
you respect the most?
ugh.
Tough question.
I would have to think about that. I follow so many people. I like Luke Groman. He's pretty good. I like some of these people. My memory's not that good. I would have to think about it a little bit more. I like well, Harris Kupperman, but I've known him for many years. Let's see. I'll tell you another guy I like because I'm so my second biggest theme is offshore oil and gas. I like Tommy Deepwater. He's pretty good. There's another guy in the shipping industry. I like his name's Ed. I don't know. He always has a picture of Onassis as his thing. I can't remember. So it's hard for me to say.
Okay, that's
yeah,
4.
but mostly I probably have a couple hundred people that I follow that, and that's one thing. Just let me make this one last comment on that.
Sure.
It's very important that people should be curating people that they're following because there's so many smart people on there. Some of these people only have 1,000 or 2. I mean, I'm talking about really smart portfolio managers or investors, and you can actually reach out to them and they're happy to interact with you.
Yes.
And you can gain a lot of knowledge just lurking. So I encourage people to do that. Don't screw around with all the political stuff. That's a waste of time. But Trader Ferg, another guy I like, Fergus Cullen, he's great. So yeah, I mean, I think people should be utilizing that because I think it's a tremendous wealth of knowledge. Kind of use these people as your analysts on your team. They're your analysts.
Yeah, pre-analysts. Yeah,
they come up with ideas and then you can deep dive them. Yeah.
Yeah, sure. No, it makes sense. Okay, how can people and investors reach out to you and subscribe to your newsletter?
So I moved everything to Substack, so you can just go on Substack. I have a free weekly newsletter that comes out, email. All the stuff I'm reading or podcasts, whatever I'm thinking is interesting that week. And then I have, of course, my weekly YouTube video, which people can look at where we talk about these themes. And then the paid newsletter is where we delve down into specific, what I'm doing specifically to take advantage of some of these ideas we've talked about.
Okay.
And that's all on Substack. Yeah.
Yeah. That was John Polomny. John, thank you for coming to my show. It was a great chat, and I hope we will catch up sometime soon again. Thank you very much.
Thank you.